Hey guys, Jim Thornton here, RMA, Brantford, Ontario. Just wanted to talk to you today about the secrets of qualifying for a mortgage. In particular, I wanted to talk a little bit about affordability. Not so much what you can afford, but what the government says you can afford. There used to be a time you'd be able to walk into a bank, tell them you want a mortgage, they'd look on a rate sheet and say, here's your rate, and that you would know what your qualifications are. Things are a lot more complex these days on how they work. Thanks to legislation, things like the stress test are getting in the way of affordability for a lot of people these days. What I wanted to cover today is a basic framework on how to qualify for the mortgage and some of the things that you can do to make it a little bit more affordable. In particular, some of the things are going to be your down payment, your affordability, purchase prices, things like that. It's important for you to know that you should talk to a mortgage professional or a mortgage agent or broker before going ahead and buying a place, just so you know what you can qualify for. Okay, the first thing that we're going to cover is we're going to cover down payment. When you buy a house, you're going to have to put a down payment down. This is different than deposit. When you put in an offer to buy a house, you're going to give a deposit, $5,000, $10,000, $20,000 when you put in the offer to buy. That's different from the down payment. The down payment is let's say, okay, we're buying a house for $500,000. How much is going to come out of your pocket and how much is going to come out of the bank? So first off, when you buy a house, there's three different categories. There's 500,000 and less, and then there's between 500,000 and a million, and then there's over a million. In the first category of 500,000 or less, the minimum down payment is 5%. So if you buy a house for $500,000, you can put $25,000 down as a minimum down payment. In the second category, it's a little bit more complex. The way it works is the first 500,000 is 5%. Anything above that is going to be 10%. So let's say you're buying a house for $750,000. So 500,000 of it's going to require a $25,000 deposit, and then the other 250,000 is going to require another $25,000. So in total, if you bought a house for 750,000, your minimum down payment is going to be $50,000. When you get a house that's a million or more, because there's no CMHC involved, you have to put 20% down as a minimum down payment. So in that case, you'd have to put $200,000 down if you bought a house for $1 million. Now, in addition to the down payment, what you're also going to have to do is you're going to have to cover your legal fees. So now the way this works is whatever the legal fees cost you is what they're going to cost you. But the bank wants to see ahead of time that you have at least 1.5% of the purchase price for the legal fees. So let's say, for example, you're buying a house for $500,000. Your down payment's going to be $25,000, and then you have to have 1.5% for the closing costs. So you'd have to have an additional $7,500. So what happens is when you've got this down payment and closing costs, you have to prove it to the bank. So whichever lender we end up going with, they're all the same due to anti-money laundering laws. You have to show a history of 90 days for the down payment and the closing costs, okay? So what that means is you're gonna have to show bank statements, or if you're getting the money from a family, which we'll talk about, you're gonna have to show the money going into your bank account and then show the bank statements and so forth. The biggest thing is though, is that you've gotta prove where the money's coming from, and you're gonna have to have the down payment and closing costs. It's important to know that what the bank says they need to see for closing costs, the 1.5%, that's not what it's actually going to be. The legal fees are going to be in there. You've got land transfer taxes that are going to be in there, and you've got disbursements that are going to be in there. So depending on where you're buying, if you're buying in Toronto, for example, your land transfer tax is double where it is in other places. So it's really important to talk to somebody like a mortgage broker or mortgage agent and get them to run down what your approximate closing costs are actually going to be. But notwithstanding that, you're going to have to show 1.5% of the purchase price to the bank that you have that in addition to the down payment. Okay, we talked about needing the money and that you can get if you're getting a gift from a parent, for example. So let's say you don't have the down payment by yourself. It's okay to get money from a family member. It has to be a direct lineage. It can't be cousins or aunts. It can't be family friends. It has to be parent, grandparent, child, grandchild, or siblings. But basically, let's say you have to put down $50,000 and you're going to get $40,000 of that from your parents. Basically what you would do is you would get a letter from your parents signed that says they're giving you the money. It's not a loan and they don't expect for the money to be paid back. And they're going to give you that $40,000. You're going to have a letter signed from them matching the $40,000 going into the bank account. And then that covers that. And then you would just have to come up with the difference. It's also possible to get borrowed down payments, but in order to do that, with the stress test and everything else, it makes qualifying even harder. So a lot of people aren't really going that route these days. The next thing we're going to talk about is the stress test. When you're qualifying for a mortgage, we have to deal with something today called the stress test. This is a big hurdle for a lot of people. The stress test was first introduced around just shortly after the financial crisis in 2008. And it's changed a lot of times since it was first introduced, but the way it stands today is that we have to qualify you based on 2% over whatever your contract rate is. So let's say interest rates are around 5%. You have to qualify as if interest rates are 7%. And what that does is it adds a buffer in there so that if interest rates go up by the time your mortgage comes up for renewal, you don't have to worry about losing your house. You know you're going to be able to afford it. Sometimes having a variable rate, there could be a different calculation on how that works. So sometimes having a variable rate over a fixed rate or vice versa, one might be better than the other as far as the stress test goes. So what does the stress test impact? And basically what it impacts is something called the GDS ratio and the TDS ratio. So this is going to get a little technical, but the GDS ratio stands for gross debt to service ratio. And what goes inside of that is your mortgage payments, your property taxes, and about $100 a month for heat, and half of any condo fees. And that all comprises what's called your GDS ratio. Now, if you have under a 680 credit score, then the GDS ratio needs to be 35% or less of your income. So for example, mortgage payments, property taxes, $100 a month for heat, half of the condo fees, you add those up and you divide that by your monthly income. And as long as it's 35% of your gross monthly income or less, then you're good. If you have 680 or higher beacon score in your credit score, then you can go up to 39%. In addition to the GDS ratio, you have something called the TDS ratio, and that stands for total debt to service ratio. And basically what happens is you take your GDS, which is your mortgage payments, property taxes, heat, and half of condo fees, and you add in any of your monthly obligations. So loans, lines of credit, credit cards, things like that. For lines of credits and credit card, they take 3% of the outstanding balance. So if you owe $10,000, they count $300 a month against you. If you've got a fixed loan for a car, then they just use your car payments, for example. But you take all of those extra payments that you're obligated to, and you add it to the GDS, and then that number, if you have under a 680 credit score, then that number has to be 42% or less. And if you're 680 or over, then that number can be 44 or less. What happens if you're a little bit over on those ratios? Well, being a mortgage broker or working with a mortgage agent, we have access to a lot of products. We can deal with credit unions, we can deal with B lenders, and we can deal with different things like that. So we have ways of getting around those stress test issues. Depending on what the scenario is, usually you need to have 20% or more down. But one of the ways is we might be able to go to what's called a no stress product, in which case the rates are a little bit higher, but they don't count the stress test against you. The other alternative is we could go to B lenders, or we could even go to private lenders. And by going to B lenders, we can extend those ratios. Instead of being 39 and 44, we might be able to go up to 45 and 50, for example, or maybe some lenders will go up to 60 or something. There's a lot of different criteria, and every lender has their own different criteria. So having those flexibilities, we can go to a different lender to see who can qualify for what. So let's assume we're staying with a normal conventional lender, either a bank, credit union, or something like that, an A lender. We want good rates. There's 4 basic things that you can do to help manipulate these numbers to help make them qualify. If let's say you're just slightly over the numbers, over those percentages. One of the first things that you can do is sometimes changing terms. Sometimes instead of going with a 5-year term, you go with a 3-year term or a 2-year term, or you go with a variable rate. There might be different qualifications for each one, and that might be enough to bump you within the qualifications. The second thing that you can do, obviously, is you can increase your down payment. By increasing your down payment, what that does is it lowers the mortgage amount. That lowers your monthly payments, which in turn will lower those percentages that we talked about. The other thing that you can do is if you have 20% or more, then you can also increase the amortization. So instead of doing a 25-year mortgage, maybe you can do a 30-year mortgage. And there's talk about some lenders starting to reintroduce the 35-year mortgage, but that's not happening yet. But by going from a 25-year mortgage to a 30-year mortgage, that might give you a little bump right there if you're putting a large enough down payment down. The other thing you can do is obviously lower the purchase price. This is usually the last option people want to do, especially because house prices have been so crazy lately. But by lowering the purchase price, that also lowers the amount of down payment you need, which will also lower the monthly mortgage amount and on the payments for you. Really, the last thing that you can do to help lower the TDS ratio or the total payments that you're paying is to pay off some of your debt. So let's say you've got credit cards, lines of credit, you've got a car loan or whatever. Sometimes paying off those loans can help make a big impact on the payment. For example, if you decided to get rid of a car loan, all of a sudden now you don't have a $600 or $700 payment going against you, and then that will knock your TDS ratio in line. So it's important that you talk to a mortgage broker and agent before you go doing that, because a lot of times clients will have the tendency to pay off either the highest interest rate, or they might just start consolidating stuff, and that might not be the best thing to do. Maybe in the long term financially that would be a good thing to do, but in the purpose of qualifying for a mortgage, sometimes paying off specific debts is better than paying off other debts. Typically what we want to focus on is we want to focus on the debts with the highest payment. And it doesn't matter if you partially pay down a loan, for example. So if you owe $20,000 on your car and you decide, oh, I'm going to pay off $15,000 on my car, that doesn't matter because you still have to pay the same payment. Whereas if we applied that to a credit card or a line of credit or something, that can make a big difference because it would lower your payments by 3% of the amount you paid. So in this case, $450 a month. The biggest thing though is that we've got to take a look at your situation and figure out where's the best way to apply the money, and then how can we do that. And one of the things that a lot of people aren't aware of is we might even be able to get you the money to pay off those debts. We've had clients many times where the bank could only get them X number of dollars, and I was able to get them approved for much higher, and that's just simply because I got them a cashback mortgage, got them the money to pay off specific debts, and we worked out the scenario so that they could qualify for a lot more than they could get at a normal bank. And the best part is they got a better rate than if they had done it through a normal bank anyways. So all in all, there's a lot of things that you can do to help your financial situation and to help qualify or potentially get an increase in how much you can qualify for a mortgage. It's important to talk to a mortgage broker or a mortgage agent about your specific situation. But if you have any questions or whatever, feel free to reach out. I'd be happy to answer any questions.